Good afternoon, everyone, and welcome to our first quarter 2026 Market Insights webinar. We're here to share with you our thoughts on what happened during the first quarter, as well as what to watch for the remainder of the year. Now, the usual logistics before we get started. If you'd like to submit a question, please do so using the Q&A feature. We will do our best to cover the questions live. If we are not able to answer them live, we will circle back with an answer. Today's webinar, along with all past webinars, is recorded and uploaded to our YouTube channel. This should be available tomorrow. So if you would like to rewatch or share with colleagues, please do so. Now, the usual introductions. My name is Greg Lamberger. I'm the Director of Research here at Marquette Associates. I'm going to cover both the U.S. economy and private credit. James Torgerson is going to review fixed income. Then Fred and David are going to review U.S. equities and non-U.S. equities. We'll then move to the alternatives portion of this afternoon's webinar. Evan Fraser will discuss hedge funds. Dennis will review real assets, which consist of real estate and infrastructure. Haley McCollum will cover private equity, and I will finish with private credit. So when we do these webinars, we like to start with the U.S. economy. It's really the backdrop to most of the capital markets we're going to discuss today. And I'm here to talk to you about two macroeconomic variables which have been in the news quite a bit: inflation and unemployment. We'll start with inflation. And with the escalation of the U.S.-Iran conflict starting in late February, one of the immediate knock-on effects was a large escalation in oil prices and, by extension, gasoline prices. Those are captured in the CPI metric, which measures inflation. Not surprisingly, that came in at an elevated level of 3.3% in March. However, the core CPI number, which carves out volatile energy prices, was at 2.6%, slightly below expectations of 2.7%. Going forward, this bears monitoring. Certainly, the longer the ceasefire holds and if a longer-term resolution is reached, we would expect CPI to approach its longer-term averages, which we saw leading up to the conflict, somewhere in the 2 to 2.5% range. Now, the better part of the story is in the employment front. The March jobs report revealed that 178,000 jobs were created and the unemployment rate dropped down to 4.3%. So from an employment perspective, things look pretty good. At the end of the day, the Federal Reserve is charged with balancing both full employment and keep inflation under control, also known as the dual mandate. Employment, per the slide prior, appears to be relatively healthy. Inflation, however, is the wild card. We need to continue to monitor inflation. And if inflation should somehow spike because of prolonged oil prices, gas prices, or any other source of increase in CPI, which appears to be longer term in nature, the Federal Reserve may be forced to increase interest rates like it did in 2022 to combat inflation. However, at this point in time, there are zero interest rate cuts or increases expected. Of course, this is all reactive to data, dependent upon data, depending not only what happens in inflation, but employment and economic growth. But as we sit here today, zero cuts are expected for the remainder of the year. As we look at projections of GDP, really the ultimate indicator of economic growth and health, those expectations are more or less in line with what we talked about in the 2026 preview, somewhere around to 2 to 2.5% for the next 12 months. So with that in mind, let's move over to fixed income. And there's always a very natural transition from Fed policy into fixed income and what that means for the asset class. So James, you can take it from here.
Thanks, Greg. Appreciate it. So fixed income performance in Q1, the Ides of March really reared their head as the shock to oil prices sent treasury rates much higher on renewed inflation fears. The AG ended up finishing flat for the quarter after March returns erased solid gains in January and February. This spike in yields put the brakes on what we've described on the Q4 webinar as kind of a near-term fixed income bull market since the spike in rates back in 2022. So just taking a look real quickly below IG credit, performance was volatile within the quarter there. Software disruptions related to AI fears really weighed on performance, particularly within loans, which we'll touch on a bit later. So Treasury rates hit their year-to-date low on February 27th at sub 4%. Obviously, this was very short-lived as the next day the U.S. carried out its initial strike on Iran. Rates spiked 50 basis points in the aftermath of this, with investors demanding additional compensation as these soaring oil prices stoked renewed inflation fears. And Greg just talked on CPI and inflation, but while the broad trend of inflation appears to be relatively contained, core CPI came in lower than expected in March. Sustained higher oil prices could put upward pressure on headline inflation for the foreseeable future. So not to belabor the increase in interest rates during the quarter, but the yield curve also repriced higher across all maturities as a result of this conflict. Rates have come down recently since April started, but still remain elevated relative to year end. So taking a look at the term premium, which is something we've discussed on a couple webinars now, the expanding term premium we've been seeing compressed in the quarter as short-term rates moved higher relative to back-end rates. The market quickly discarded the notion of more Fed rate cuts as upward pressure was put on inflation. The day before the strikes and the day of the year-to-date low in yields, market expectations were for roughly 2.5 cuts this year. The expectations, as Greg also touched on, are now for 0 cuts in 2026, which is a pretty large reversal. However, there is still plenty of positive roll opportunities going further out the curve. So now some good news on the rate front. While obviously this was negative in March, starting yields are now higher than year end following this spike, materially so in some sectors, particularly loans. So yeah, this filtered through to all areas of fixed income, but disruption fears from AI related impacts really were notable in leverage loans. So improvement in starting yields is something we've continually talked about, provides ample income cushion should risk off sentiment continue or accelerate. However, the possibility of higher inflation would put further upward pressure on rates. This would be a near-term negative event for fixed income returns, and this does bear monitoring. While higher rates are positive now, continued higher rates could be a headwind in the future. So talk on this every time as well, looking at forward returns. We keep beating this drum. Starting yields are one of the most important factors in fixed income because it is the income component of your returns. Carry will carry the day for investors, for a nice little pun there. But this increase in starting yields we've seen only improves over already largely positive forward return scenarios for fixed income. So transitioning to spreads. Normally, this is where I say for about the 8th webinar in a row that spreads are tight, and which, to be fair, spreads are still tight relative to history. However, the geopolitical shock we've seen and the headwinds to the tech sector really drove spreads wider, particularly in loans, as well as high yield. While valuations are still on the rich side, there's at least a sign of life for spread valuations, albeit the cost of this is large-scale geopolitical disruptions. And then a very large headline throughout the quarter, particularly in February, and maybe a little more so impacting on the private credit side, but this also is filtered through to public below investment grade. The conflict with Iran ultimately overshadowed a lot of this, but turmoil in the software space from fears of AI-related disruptions caused significant volatility and really weighed on below investment grade performance. You can really see that in the loan space, particularly in the software sector. The impact of loan returns was significantly more pronounced due to the significantly larger weighting of tech within the loan market relative to the high yield market, depending on the index. But this here says 16% of the loan index is tech, while roughly 4% is high yield, or 4% in the high yield index. However, loans were the only positive performer in March. Part of this was driven by the spike in interest rates and loans floating rate coupon, which lacks duration. So that was a benefit there, but also the reversal in the tech sector performance. Not all of it, there is credit stress, but a lot of February's sell-off was a bit overblown, depending on who you talk to, but it was kind of a baby with the bathwater situation. While AI may ultimately and will ultimately have significant impacts on tech companies broadly, large swaths of this sector are still very insulated to AI disruptions in the near and medium term. Impacts are largely contained right now to very low margin subscription-based sales as service type companies or annual recurring loans in this market. This has allowed opportunistic and active managers to really scoop up solid companies at cheaper prices. And so finishing up here with defaults, not to speak out of both sides of my mouth. I just said the sell-off in tech, the impacts there is a bit overblown, but stress is building in the loan market given disruptions from AI. While the current impacts are a bit, probably overblown based on headlines, there are certainly poor companies and weaker credits that will have issues remaining a going concern as a result of AI impacts. It's just the truth. This has led to a spike in the amount of credit trading at distressed levels across high yield and loans. This has caused near-term default forecasts to revise higher. While 2026 forecasts have not been revised higher and defaults currently remain low on a trailing 12-month basis, 2027 defaults have been increased, slightly so in high yield by about 25 basis points and by about whole percent in loans. But however, fundamentals remain solid in credit. Leverage levels are low, there's higher interest coverage, and headline defaults do remain low. But I would not be doing my job if I didn't say the possibility of increasing defaults warrants further monitoring. And then just finishing up with opportunities and risks. A lot of these stay the same, very stable opportunities. And that's because fixing is a stable asset class with income generation. You have stable income generation right now. We've been beating this drum for a while, but higher starting yields mitigates your downside. The income generation should buoy your portfolio in risk-off events. The return of the term premium is also something we've talked about as well. Even though compressed slightly, you still have positive roll opportunities moving farther out on the yield curve, which did not exist for multiple years before the past year. And then finally, dispersion in credit markets. While there is stress building, while there are some credit cracks showing, the elevated dispersion in credit, and particularly below investment grade, high yield and leverage loans, is actually an opportunity for active managers. While things will sell off broadly, there are companies that are fundamentals remain very strong in a lot of these companies, and managers who are actively able to scoop up things at a discount. And then touching on risk here, the bond vigilantes. So as developed markets continue to run large budget deficits, at some point investors are going to start demanding higher compensation for this. This could put pressure on back end rates, and we've kind of seen a little bit of this already. And then the Fed's conundrum. So the Fed is in kind of a tight spot. The oil price shock is putting upward pressure on inflation. It was already somewhat trending down, but still remained above target. There's a bit of a mixed jobs market, and they're also transitioning to a new chair. This all complicates the Fed's efforts to land the soft landing plane. And then finally, wildcards. We say this every time, and a lot of the times it's just kind of a catch-all bucket for risks, but wildcards really came to fruition in Q1. Hence, we never know when they're going to happen, hence why they're wildcards. Many of these remain and always crop up at unexpected times. This really underscores the importance of maintaining diversity across your fixed income portfolio.
And critically, for fixed income as an asset class, one of the primary roles of fixed income, investment grade fixed income, is preservation of capital and diversification in times that wild cards can roil the markets. And we really saw that play out over the last month or 6 weeks here. So James, thanks for covering fixed income. Let's go over to U.S. equities now. And Fred, a lot to talk about here. Certainly, the U.S. equity market is in a different place today than it was this time last year, even 3 months ago. It's a different outlook and a different story. So I'll hand it to you and let you take us through the asset class.
Great. So for the first quarter, two narratives drove market performance. The first is the continued rotation away from concentrated mega cap exposures, which accelerated in 2026 as concerns around AI disruption spread across software companies. Investors wrestled with which companies would be hurt rather than helped by the rapid advancement of AI. The second story was the geopolitical shock at the end of February as the United States and Israel launched large-scale airstrikes on Iran, targeting military bases and oil infrastructure. Looking at equities performance, markets broadly ended the quarter down, with the Russell 3000 and S&P 500 both down around 4%. Much of this was from March, when the U.S. Attacked Iran. Prior to that, the market was relatively flat for the year. Diving a little deeper, value indices meaningfully outperformed their growth equivalents as the markets continued to rotate away from tech names across market caps. Here you can see the performance of value and growth. From the beginning of last year up until March, you can see that value stocks were less volatile than growth, declining less as markets fell last April during Liberation Day, but also rallying slower as equities recovered. You can see a clear rotation as growth drove much of market performance last year, but for this year, value is meaningfully outperforming. Looking at sector performance, value sectors with heavy tangible assets are dramatically outperforming growth for the year, with energy, utilities, and materials driving market performance. I'll note that unlike previous years, tech is now a drag on performance for the year. Much of that is driven by software underperformance around concerns of potential AI disruption. At the same time, higher oil prices have adversely affected energy-intensive sectors like commercial airlines, but benefited oil-producing sectors. U.S. oil producers are a net beneficiary from the conflict in Iran as oil prices spike higher. Some of the oil supply that in the past was sourced from the Middle East is now coming from U.S. refineries. Looking at factor performance, value and income from defensive sectors contributed to returns, while growth was the biggest detractor. Size was also a contributor as small caps outperformed the mega cap names. Here, I wanted to emphasize that historically, especially in volatile years, drawdowns are not predictive of long-term results. The drawdown this year so far looks relatively tame compared to previous years and is not predictive of any potential outcome for this year. To emphasize that, 2 weeks since quarter end, the S&P has now made a full recovery, and we're now in new highs for the year. Here we see that the breadth of the market is also increasing away from the historically concentrated areas. You can see that for the year, the equal weighted index was actually positive compared to the traditional market cap weighted index. The main reason for this is that, unlike the last 3 years, the Magnificent Seven are now a significant detractor from the S&P 500's performance. For the first quarter, they contributed roughly 85% to the underperformance of the index. Having said all that, equity valuations are still elevated, especially in large cap companies, despite the modest pullback in March. Looking at the decomposition, for the year, the drawdown so far was entirely from multiple compression. At the same time, earnings outlooks remain strong, signaling significant repricing within the market. So to wrap things up, for equities, U.S. equities, looking forward, I want to highlight that earnings remain a key opportunity, with expectations that profit expansion will broaden beyond mega cap technology stocks into sectors such as industrials, financials, and cyclicals. This shift in leadership could improve market breadth and create a more supportive environment for active managers who are positioned outside the most crowded trades. If earnings delivery meets expectations, equities may generate positive returns even in a more constrained valuation environment. At the same time, AI-related CapEx remains a structural tailwind that extends beyond traditional technology companies. Investment in data centers, semiconductors, and energy infrastructure benefits a wider ecosystem, including industrials and utilities. Over time, this could support productivity gains and margin expansion across multiple sectors, reinforcing long-term earnings growth. The risks to the market for this year are obviously the ongoing conflict in Iran, which can adversely impact energy markets and introduces an additional layer of uncertainty for investors. Rising oil prices may spur inflation and reduce consumer purchasing power, creating a potential drag on economic growth. These dynamics can lead to increased market volatility and a more pronounced sector dispersion. Related to that, Federal Reserve policy risk is tied to the inflation outlook and represents another key uncertainty for equities. A higher for longer rate environment would increase discount rates and weigh on valuation multiples, particularly for growth-oriented stocks. Markets may also be vulnerable to volatility if the rate cut expectations are pushed further out.
Thanks, Fred. And the sensitivity of equity markets relative to geopolitical turmoil has really been reinforced of what we've seen the last 6 weeks. And I think even just the last 2 weeks speaks to that most powerfully, in that a ceasefire was agreed to, suddenly the S&P 500 not only recovered all losses from the initial days of the conflict, but it's now hit all-time highs. And that's true of the NASDAQ index as well. So again, the degree and length of the conflict between the U.S. and Iran, or if a resolution is reached sooner rather than later, and that holds long term, that should be supportive of equity markets going forward. And it's true for U.S. and non-U.S. So David, without me giving any more background to non-U.S., I'll let you take it from here.
Yeah, similar to U.S. equities, non-U.S. equities sold off in March. The Iranian conflict disrupted and reversed the strong gains that non-U.S. equities produced in January and February. Though still leading year to date, emerging market equities were the worst performers in March as Asian countries struggled. This area of the market had been some of the top performers that we've seen over the last several quarters, but post the conflict with Iran, it sold off. And I'll talk a little bit about why it was hurt more than some of the other areas in a couple of slides. Now, despite the March losses, the trailing one-year returns for non-U.S. equities are north of 20%, and the trailing three-year returns are north of 10%. And so that really exemplifies the strong run that investors have experienced from non-U.S. equities. Now, when we break the performance out by sector, March was clearly a challenging environment, and this was the direct result of the Iranian conflict. There was a global disruption to energy supply due to the closure of the Strait of Hormuz. Crude prices soared higher, nearly doubling, and that pushed the energy sector up. And similar to the U.S. equity market, energy was the lone bright spot. It posted a positive return in the month of March, up 10%. All other sectors were negative for the month of March. Now, in my first slide, I mentioned that several Asian countries sold off at the end of the quarter, and this chart helps explain why that occurred. Asia is by far the largest recipient of oil transported through the Strait of Hormuz. You have Taiwan, Korea, India, Japan, and China that account for the majority of the shipments. Korea, Japan, and Taiwan are especially susceptible to the closure, as roughly 70% of each country's oil imports come from the Middle East. So given this dependence, it's no surprise to see that Korean equities lost 25% in the month of March once the conflict started. Now, despite these losses, Korea still generated a 16.5% return in the first quarter. And this highlights how strong of a performer Korea had been, as that market made several all-time highs all the way through February 2026. And if you think about Korea and you think about Taiwan, these two countries have significant exposure to semiconductor companies, which have been tremendous beneficiaries of the AI boom. So while software and parts of the AI ecosystem had come under pressure before the Iranian conflict began, chip makers and hardware companies had continued to post strong returns. However, these companies are large consumers of energy. Additionally, helium is an essential production component. So most of us use helium to blow up balloons or produce that high-pitched funny voice, but semiconductors use helium to cool wafers in their production process. And the Middle East is a large supplier of helium. So the Iranian conflict has created a short-term supply issue for energy and helium, which has impacted some of the strongest performing markets and companies within non-U.S. equities. Now, currency has served as an additional headwind in the first quarter. The dollar strengthened. Currencies detracted 1.4% from developed markets, 2.3% from emerging markets. The dollar was viewed as a safe haven asset in the risk-off environment. Additionally, currency movements were likely influenced by the repricing of Fed easing expectations, with which Greg and James both spoke about in their sections. Now, that change in U.S. interest rate expectation is the result of inflation concerns stemming from the energy supply shock. In the OECD's Economic Outlook interim report, which they produced in March, the organization noted that a further spike in energy prices would hit growth and inflation significantly. Based on the OECD simulation models, the forecast of further oil price increases would cause consumer price levels to rise, as well as a contraction in economic growth throughout the globe. And as we saw in my third slide, the Asian markets appear to be particularly exposed to this supply shock. Now, with concerns of global inflation, interest rate forecasts for much of the developed world has shifted. Forecasters expect the European Central Bank, Bank of Japan, Bank of England to potentially move policy rates higher in order to combat increasing prices. And these tighter financial conditions can serve as a headwind. In 2025, multiple expansion and currency appreciation were the largest contributors to return for non-U.S. equities. Earnings, they were slightly positive last year, but the expectations for 2026 were calling for double-digit growth out of non-U.S. equities. And through the first 2 months of this year, the initial earnings data was looking positive, and that was supporting the returns that we were seeing in January and February. However, the dramatic shift in the outlook for inflation and interest rates increases the uncertainty around 2026 earnings. And in our annual preview, we noted that higher valuations removed some of the downside cushion in the event of market volatility. And despite the March sell-off that occurred, valuation for large cap non-U.S. stocks still remain elevated relative to history. Now, they did come down from the December 2025 levels, but the returns for non-U.S. equities for the rest of this year are likely going to be dependent on companies delivering on earnings because valuations are higher. And as I said, the impacts of the Iranian conflict, particularly around economic growth, inflation, and interest rates, they serve as a potential headwind to company earnings. And so the longer this conflict persists, the greater the likelihood of a negative impact on company results. So that earnings dynamic, we believe, is a key risk for non-U.S. equities in 2026 and perhaps might be one of the biggest risks this year. We also noted that tariffs still have the potential to impact bottom lines for non-U.S. companies. From an opportunity perspective, I spoke about the short-term concerns in Asia. We think that the long-term outlook remains positive for Asia technology stocks, despite the short-term headwinds. Another note we would say is that if the conflict does persist, economies with greater energy independence could benefit on a relative basis. Certainly, the United States. You could also think of a country like Brazil. Fiscal spending, more on the longer term. Fiscal spending in Europe and Japan could provide opportunities there over the next couple of years once this conflict is weathered. But again, the main focus right now is the conflict in the Middle East. It'll have a tremendous influence on returns for the rest of the year.
Thank you, David. And that's a point that we made in the U.S. equity section, and we'll hear in further sections as well. We really can't emphasize that enough. And then another thing to touch on that you talked about is the earnings dynamic and that being a risk. Certainly in 2025, international equities did very well. A lot of that was a result of multiple expansion rather than earnings. So we really need to see solid earnings meet expectations or exceed expectations to strengthen the foundation for further increases amongst non-U.S. equities. Okay, so that's the traditional portion of this afternoon's webinar. Now we're going to transition to alternatives, and Evan Fraser will lead it off with hedge funds.
Thank you, Greg. So despite a somewhat challenging March, hedge funds did do a pretty good job of protecting capital during the first quarter. As we can see here, most strategy types remain at least modestly positive on a year-to-date basis, despite a pullback in the equity markets in 1Q. So, for instance, the global macro index notched a return of around 4.5% during the first quarter, despite being down more than 2% last month. These are sort of flexible, go-anywhere type strategies that can benefit from volatility across different asset classes. The equity hedge index, which you may recall is coming off a very strong 2025 when it was up more than 17%, was down about 50 basis points for the quarter. Considering that the S&P 500 was down more than 4% in 1Q, I'd say that negative 50 bips is actually pretty solid. And then the other higher beta index on this list is the put right index there at the bottom, down a little more than 1% in the first quarter. This is sort of well within the range of expected outcomes for that index, given what the broad market did. So I think that the key takeaway here is that despite some kind of short-term turbulence, hedge funds broadly demonstrated resilience in 1Q and continue to deliver on their role as portfolio diversifiers. So this slide highlights the performance spread between popular hedge fund long and short positions, as well as the broader equity market, which is the green line, the S&P 500. And this can kind of give us a sense of what drove equity long short returns in the first quarter. And sort of as you can see, crowded longs, that's the purple line, outperformed both the S&P 500 and the most heavily shorted names by roughly 4 percentage points during the quarter, despite a slightly negative absolute return. Crowded shorts, that's the blue line, actually outperformed the broad market in 1Q, albeit by a negligible margin. So the outperformance of the equity hedge index last quarter was pretty much entirely driven by alpha contributions from longs, indicating that hedge funds were able to effectively position their long books during a period of relative stress. So, of course, oil has been sort of the hot commodity of late due to the ongoing conflict between the U.S. and Iran. Brent crude, for instance, is up about 55% since the start of the year as a result of that conflict. And hedge funds who are able to trade oil futures, commodities futures contracts have definitely taken note of this. So hedge funds have been net long oil for about a year and a half at this point. But what's notable notable here is the extent to which long positioning has increased in recent months. And as you can see, it now sits close to a 5-year high. What's notable here too is that funds have been sort of adding to their oil positioning in the lead up to the first U.S. strikes on Iran, such that by the end of February, which is when the conflict really kicked off, hedge funds already had meaningful oil exposures in place. So that has certainly been a performance tailwind for the asset class, and you're likely to see long oil exposure remain elevated in the weeks ahead, which I'd say creates both opportunity and risk. On one hand, if the conflict continues to fester, funds stand to benefit from this trade. At the same time, this type of sort of crowded positioning also increases the potential for sharp reversals on the part of hedge fund performance if the narrative shifts. And when you're dealing with geopolitical issues, especially with this administration, narratives can shift pretty quickly. So as a result of these geopolitical issues, equity market volatility certainly increased in 1Q. Here we can see that the VIX climbed to above 30 during the quarter for the first time since Liberation Day about 1 year ago. And I believe we actually included a very similar slide in the webinar post-Liberation Day last year, and we thought we'd kind of bring it back this go around and kind of underscore the point that volatility actually tends to be good for hedge funds on a relative basis. So you can see in the box there that equity hedge strategies have actually outperformed the S&P 500 by about 80 basis points when the VIX is a standard deviation or more above its long-term average. And strategies like global macro, relative value, merger arb, et cetera, tend to see even stronger relative results when the VIX is higher than normal. And that's because when volatility rises above average levels, dispersion increases, correlations tend to break down, and opportunities for alpha generation improve. And while we've pointed out in the past that recent volatility spikes have tended to normalize very quickly, there are reasons to believe that we may remain in a structurally higher volatility regime, at least relative to the last couple of years going forward, due to the geopolitical tensions, inflation uncertainty, other factors that have been mentioned earlier today. And if that's the case, that could be supportive for hedge funds, at least on a relative basis going forward. So I alluded to this just now, but 1Q saw a meaningful increase in cross-asset dispersion. So on the last slide, we were just looking at the VIX, which is a measure of equity market volatility. Here we're looking at dispersion across 5 segments of the kind of broader market. So equities, oil, the US dollar, bonds, and then credit. And we're basically just trying to get a sense of how each market is moving in relation to the others. These asset classes, of course, are never going to be perfectly correlated, so you're always going to see some dispersion here. But as you can see, this sort of cross-asset dispersion reached a nearly 4-year high in 1Q as we saw oil prices skyrocket, equity markets draw down, the dollar kind of move sideways, and then bonds and credit markets sort of exhibiting a little bit of volatility. So we have different assets behaving in different ways. And this type of an environment is typically constructive for hedge funds. Greater dispersion creates more relative value opportunities, allowing managers to exploit mispricings across various markets. This is especially relevant for managers in spaces like, again, global macro, RV, multi-strategy that can trade across different asset classes given a certain opportunity set. So if this type of cross-asset volatility persists, that could be a tailwind for those types of funds going forward. So I'll wrap up with a summary of opportunities and risks for the hedge fund space. So on the opportunity side, hedge funds continue to offer strong diversification, benefits, and capital preservation characteristics, particularly in uncertain market environments like the one in which we find ourselves now. And if we do see elevated volatility and higher dispersion in the months ahead, that should provide a fertile environment for alpha generation. On the risk side, so elevated macroeconomic tensions, it kind of cut both ways to a certain extent. So we've seen recent market turbulence lead to drawdowns for a couple of sort of prominent multi-manager, multi-strat strategies. I think that emphasizes the point that more exogenous macro-oriented shocks can be hard to dodge, even for those managers who purport to be completely market neutral, beta neutral, et cetera. But on the whole, I think that if near-term volatility persists, funds that are able to effectively position themselves could actually see even stronger returns relative, to broad equity markets, certainly, than they otherwise would have exhibited in a more benign market environment. But of course, manager selection is crucially important in a space like hedge funds, especially at a time like now. And I think that's all I have. So with that, Greg, I will turn it back over to you.
Thanks, Evan. It's always a little bit of a different narrative around hedge funds as it relates to volatility, because volatility actually creates a lot of opportunities for hedge funds to add value, particularly in down markets, to preserve capital that may be disappearing in the equity markets. So thanks for the summary there. And let's move over to real assets now, with real estate and infrastructure. Dennis, all yours.
Absolutely. Thank you, Greg. I'll start off with real estate. As a reminder, private real estate and infrastructure performance are reported on a lagged basis. For the fourth quarter of last year, the NFI Odyssey Index achieved a total gross return of 0.9%. This was driven by a 1% income and negative 0.1% appreciation. As a result, we are currently witnessing 6 quarters of consecutive positive returns. As valuation stabilized and capital returns, real estate is transitioning into an early stage of a new cycle. On top of performance, transaction activity has also been recovering. Following the sharp decline in 2022 and in 2023, volumes have started to normalize, supported by improving price discovery and a more active debt market. Overall liquidity is coming back into real estate, and this is important because transaction volume is one of the best indicators of market health. Turning to fundamentals, net operating income growth is expected to be the primary driver of real estate returns going forward, especially in an environment where cap rate compression is unlikely to do much of the heavy lifting there. Industrial stands out as the leader both historically and on going forward basis. Specifically, forward-looking expectations move closer to the mid-single digit. Outlook for multifamily and retail are both positive as well, but office remain as the troubled sector. While some stabilization is emerging in high-quality assets, sector-wide growth is still challenged. One of the tailwinds to support real estate rebound is declining construction level. On the apartment side, new starts have fallen by more than 70% from the peak levels, and the numbers of units under construction is also in rapid decline. A similar trend is observed in industrial, where supply are shrinking after a record wave of development in 2022. In addition, occupancy remained broadly stable across most sectors, supported by steady demand and limited supply. Alternative sectors stand out on a forward-looking basis. Senior housing continued to recover, driven by strong demographic demand and very limited new supply. Data centers remain as one of the most promising sectors, with demand from AI and cloud growth far existing available capacity right now. To summarize real estate, pockets of distress remain across real estate. The non-core opportunities that have become more selective as debt market has proven to be more active than expected. Therefore, forced selling has been limited and requiring managers to patiently identify opportunities with attractive entry points. Meanwhile, sector and market selection are still important, given all sectors now lead growth outlook with diversification benefits. On the risk side, the office sector remains challenged, and construction costs are high due to proposed tariffs and labor shortages. For private infrastructure, we see 2.3% quarterly return in the third quarter last year, with 10.3% return over 1 year and consistent performance over a longer period. This indicates a steady and reliable performance for infrastructure, making it a very attractive option for investors who prefer income generation and inflation protection. Particularly, we see significant capital flow into digital infrastructure in recent quarters, and we expect the momentum will continue in the near term. This chart really highlights how aggressive the major tech firms are investing in data centers and AI infrastructure. But one of the biggest challenges of data center expansion is the demand for power. electricity demand from data centers in the US is expected to be more than tripled over the next 5 years. More importantly, data centers' share of total consumption in the US will go up quickly. It currently accounts for roughly 4%, but it will go up to 12% by the end of the decade. Looking at opportunity set in different regions in this chart, it really illustrates how investment focus differs between North America and Europe. In North America, capital is more concentrated in data centers than broader digital infrastructure alongside exposure to energy. This truly reflects the overall scale of AI economy in the US. In contrast, Europe is more tilted towards renewables. That's largely driven by the region's energy transition priorities and regulatory support. Overall, infrastructure remains as a reliable inflation hedging and income generating asset class. With power demand surge from AI development, and there's the growing need for energy generation and transmission. On the real estate side, GDP-linked assets can be more volatile, slow down, and asset quality, operational execution remain critical to long-term success across infrastructure sectors. With that, back to you, Greg.
Thanks, Dennis. And the real estate story is pretty consistent with really what we previewed back in January, as well as the kind of the latter half of 2025, that the recovery seems to be sustained with 6 quarters of positive returns now. And keep an eye on the alt sector. The alt sector is expected to really lead the market in terms of NOI growth as we go forward. And in terms of infrastructure, it's AI, it's data centers. There needs to be power to run these data centers. So that's kind of an opportunity. And then also, I think Dennis's last slide is also important to understand that different regions, their infrastructure investments and the makeup of their infrastructure portfolios looks different. And that's an encouragement for infrastructure funds, infrastructure investors to be playing in both markets. So let's now head to the last 2 sections of this afternoon's webinar: private markets, private equity, and private credit. Haley, you can lead it off, and I'll take it home.
Awesome. So just like real estate and infrastructure, private equity performance is reported on the lag, and full year-end results are still coming in. But as of 3Q of last year, private equity and venture capital generated positive returns, but trailed public markets. Now, this gap was largely because of the strong public market performance, not poor private equity performance. Now, within private equity, U.S. venture capital was the strongest performer of the quarter at about 6%, while expansion capital across U.S. and globals were close to flat, but still positive. Over the long term, U.S. small buyouts continues to be the highest performing area within private equity. Important to note, though, private equity is a long-term allocation designed to compound capital over time, and short-term performance relative to public markets can vary meaningfully depending on where we are in the market cycle. We continue to see a significant dispersion amongst managers in private equity, reinforcing that manager selection remains a key driver of outperformance within private markets. We still believe that this asset class remains well-positioned to deliver attractive long-term returns as financing conditions and transaction activity continues to normalize. On the deal activity front, so despite a post-Liberation Day slowdown, global private equity deal value exceeded $1 trillion in 2025, only the second time on record. So lower policy rates, improved financing conditions, and supported a rebound, especially in the leveraged buyout and mega buyout deals. And also M&A surpassed 2021 highs, so it was an all-time high for M&A activity. Exits also improved, notably towards the end of the year, which is typical for private equity. Also, the exit to investment ratio has begun to normalize, trending back to pre-pandemic levels. And there's a noticeable spike within venture capital valuations, in particular on the later stage, and this is mostly driven by AI-related companies at the upper end of the market. Early stage valuations remain relatively stable, though somewhat elevated. Now, some opportunities and risks within private equity. So on the opportunities front, exits have picked up, but the secondary market is a big component of that, helping with liquidity. So risk is the reliance on secondary funds to generate exits. So it's something that we are cautious about as a team and monitoring. AI is helping move a slow VC market along, but valuations in AI are very high. So while activity is picking up across deal activity and exits, the biggest risk for private equity, I would say, would be the geopolitical tensions, but this is not a risk unique to private equity.
Thanks, Haley. And certainly the variables of deals and exits seem to be going in the right direction. But at the same time, we do still want to see even more exits. We want to see the IPO market really open up. And of course, we have an eye on geopolitical conflict as well. So now let's finish with private credit. And there's no denying that private credit has been in the headlines quite a bit. I want to start with some performance here and just make the summary statement that as of year end, private credit has continued to deliver strong returns, really in line with investor expectations. And if we break out private equity returns, right, and I'm sorry, private credit returns and what's driven it, there are two items on this chart I want everyone to pay attention to. And the first one is the income component of returns. That's that gray bar or light gray bar here in the chart. And note that how steady that has been going back to 2016, so going back 10 years. And then the black line traces total return. And other than the COVID dip, it has been in the high single digits to low double digits, really representing a relatively consistent return stream. And again, mostly driven by income. And as investors benefit from this consistent income generation. And losses have been minimal from private credit, despite the recent media headlines. And if we look back over the last year, annual losses detracted 64 basis points for the last 12 months. And this is below the long-term average of 100 basis points. Now, a lot of these headlines, of course, have really hit here in 2026. And what we want to do is address each one of these, kind of going micro to macro as we go down the table here. And I won't hit every bullet, but I think it's important for everyone to understand kind of what these headlines, what they're hinting at, and what the real story is for each one of them. So something that's been alluded to already in today's webinar across a couple of the different asset classes is the rise in AI and what that means for software, and then the allocation of software across private credit funds. And we won't deny that software exposure, it's not insignificant across private credit funds. But these funds are not only are they diversified by industry, but the software is diversified by end market. And a lot of the software, despite the threat that AI may eventually take it over, even if that were to take place, it's a very long track for that to happen. In a lot of other cases, this is mission critical software that really companies rely upon for their operations. And rather than AI being a threat, they could actually be enhanced from AI. So that's something we want everyone to really understand, and that just because AI is growing in popularity and growing in use and growing in utility to companies, doesn't mean it's going to completely eliminate all software out there. Certainly there will be winners and losers. But then, of course, what you've seen more redemptions from some of these large BDCs, right? A lot of investors, it appears, if you read the headlines, if you pay attention to kind of the lead line on news stories, that everyone's pulling out of private credit. But the reality is it's really concentrated. These redemptions really been concentrated with some of the largest platforms. And critically, these are funds with significant retail exposure. So institutional exposure that tends to be sticky, tends to be in it for the long term, where retail exposure tends to be more hit or miss in terms of if something's hot, more money is going in. If something's cold, more money is coming out. It's much more reactive rather than long-term in nature. So these redemptions, again, to repeat, have been driven by retail flows. And I'll point everyone to the last bullet in this section is that all of these funds are built with multiple liquidity levers. So they don't have to go and sell all their assets to meet liquidity request. And they can also gate their funds and not pay out every single redemption that is put in. But critically, there are multiple liquidity levers prior to forced asset sales to meet redemptions, and that's been the case so far. So we haven't seen funds selling a lot of their assets at deep discounts to meet those redemptions. Of course, these questions, although beg, though, is this a broader worry, or does this signal a broader deterioration in credit fundamentals? And I'd point to the fact that, and James talked about this a little bit in his section too, that defaults are below average. They're largely idiosyncratic. And if we look at coverage ratios, right, and when we look at about the amount of ability, amount of kind of cushion companies have to meet their debt payments, they're stabilized, there's sufficient cushion. And some of the primary risk factors as it relates to credit market deterioration is PIK usage or non-accruals. And non-accruals are below their long-term averages. PIK usage is really concentrated just on the upper middle market primarily. And again, those are not at troubling levels. So there's no broad indicators that the credit markets are falling apart in a bad spot. So that really answers the last question. Our private credit, does this represent systemic risk? And again, the investor base is largely institutional. It's long duration. The losses are absorbed by equity capital. And private credit represents only about 9% of total corporate debt. So this is not some broad credit event which threatens to ripple through to global markets across the world. Certainly not looking at something which could be like the 2008 GFC. And I think answering those questions really speaks to the opportunities and risks in private credit. Of course, we always want to keep our eye on what's going on behind the scenes and what redemptions look like and what the ultimate credit market profile looks like. But all in all, those are more healthy than the headlines would suggest. And again, private credit is a source of attractive yields and stable stable income. And that is the end of this afternoon's webinar. We hope that it's been a good use of the last 52 minutes of your day and leaves you all with kind of more of a story of what happened in the first quarter of the year. And of course, really the last couple of weeks, we've seen a large rebound in capital market as well. So a lot of the bad news suggested by some of the performance numbers here really isn't the case anymore, with both the S&P and NASDAQ hitting all-time highs earlier this week. If you do have questions, please reach out to any of us here. We'd be more than happy to answer questions that on topics we covered today. A version of this webinar will be available tomorrow on our website, so please go ahead and feel free to share with colleagues if that would be helpful. Thank you very much again, and enjoy the rest of your day.